pleased to have today with us Jill and Sean from Glacier Bank. Thank you for being here. Sean is he is a Vice President of Mortgage Loan Officer here at the Kalispell branch.
Correct, yeah.
And then Jill Jacobson is the Senior Vice President of Real Estate Loan Manager, and that's for all of Glacier Bank, is that correct? Okay, so thank you for being here.
Yes, thanks so much.
Appreciate both your time.
Yeah, thank you.
So the topics we wanted to talk about, we're in this really dynamic and changing real estate environment right now. Interest rates have a lot to do with it, and the overall economy has a lot to do with the shifts and changes that we're seeing in this tension between buyers and sellers. And that's what Sean was going to start with his slide deck here. So we wanted to talk about kind of 4 general topics. We're going to talk about the general economy and the outlook. He's going to give us some good data from the banking perspective of how we've gotten where we're at in recent months. We wanted to talk about the interest rate environment, where that's going, where it's come, the effect of that on the market, and then the discussion about buydowns of those interest rates as we talk with our buyers and sellers, and how we might get creative and how we help put deals together and help people accomplish a sale or get a home bought. Then we wanted to talk about the different loan options that are out there, including adjustable rate mortgages, and we want to talk about the 2-1 buy-down option. That sounds like another creative solution that we could consider and talk with clients about. And then last is assumable loans that really haven't been seriously considered since the 80s. So we're going to talk about that, and then Sean was telling me yesterday that he's hearing a lot more rumblings about short-term seller financing, just to get people in the door and wait for this interest rate environment to mellow out a little bit. So with that, I'm going to start your slideshow for you.
Super.
Stop yakking and let you run.
All right, thank you. So first slide on here is more just start this off with a little bit of humor. It's an unprecedented time. We've never really seen anything like this. When you start to hear, mortgage rates have risen at their fastest rate in 50 years, that's something that none of us have ever seen. Or when you have economic data that goes back only in time to 1981, that's never potentially a good thing. So over the last 9 months, 10 months, this is more or less of what's happened in a nutshell, that for so long it was such a seller's market, and that's changed completely. So to reset those expectations, we're trying to do that every day, and it's been a challenge, but with that challenge, I think everything that we're going to talk about today also presents an opportunity. So if you want to go to the next slide. So I guess in general, we want to talk about where we're at now, how we got here, and where we're headed. So I guess when you hear at the beginning of the year, the Fed funds rate was at basically 0%, and target goal by, call it February, March of next year, is to have it at 4.75 to 5%, which is a huge jump. And what that means short term is rates are going to stay high. There's no doubt about it that rates are going to stay high, and there's going to be kind of a tug of war between buyers and sellers, and it's going to continue. So when you hear, we'll get into this a little bit more, but when you hear the Fed is raising rates, that's indirectly tied to mortgage rates, directly tied to short-term borrowing debt. So credit cards, auto loans, HELOCs, stuff of that nature. So the beginning of the year, when prime was very low, we were offering HELOCs at 3.5%, 3.75%. Those are in the 7.5% range now. You go to apply for an auto loan, same thing, 3% for the longest time. I heard a client that quoted an auto loan with Chase at 8% yesterday, has 800 credit score. So, everything across the board is up. Recent data has shown that, and the Fed has said as much as they're going to see this through until the job's done. they don't want to get it wrong. They don't want to stop too early and have, you know, inflation peak again later next year, the year after. They just don't. So they're going to see this through until it is done. That means continuing to raise rates on Wednesday. All indications are that 75 basis points on Wednesday, they're going to go up. So immediate impact on short-term borrowing debt. We'll see what the 10-year Treasury does and what mortgage rates do. You know, let me just stop and tell you kind of where mortgage rates are now. At the beginning of the year, they were at 3%. 2 weeks ago, they peaked at about 7.3% on a 30-year fixed basis. Over the last week and a half, we've had a little bit of relief, and they're hovering right around 7%. So that's kind of where we're at on mortgage rates. But most recent data is showing that the Fed's going to continue to do this because household incomes and cash reserves are very strong across the board still. So with the influx of COVID and government stimulus, I think some of you maybe were at our economic roundtable when you heard Dennis Beam say that at Glacier Bank it took 64 years to get to $1 billion in deposits, and it took 16 months to get over $2 billion. So that's a figure that I still shake my head at, and that has a lot to do with why we have such high inflation as well. So I think we were just looking, and our deposits right now are
$2.36 billion
Wow.
that Glacier has on deposit. So that number has stayed, whereas our loan growth has stayed fairly static. That deposit rate continued to grow. So we continued to grow our deposits, but our loan growth kind of has stayed fairly flat over this last year. So just to Sean's point, there's so much cash still out there. Through that COVID, all of that COVID stimulus and all of those programs, just dumped it in the bank and there it sits.
So on that subject, if there, you know, are people that are sort of just waiting and watching the market right now, kind of opportunistic buyers, if you will, what's your projection on how that's going to play out, and where's the sweet spot for a lot of those people when they're actually going to start buying again?
Yeah, so we could probably jump next slide here. I don't know if maybe keep going a little bit. Keep going. One more. So jumping into that question, Mortgage Bankers Association forecast for rates. I don't think until summer. I think we're going to stay 7s, maybe 8s for a little bit. Definitely in that range for probably until May, June, if I had to guess.
Okay.
But they're forecasting an average fixed rate for 2023 at 5.4%, which would be great. That would be rude.
Yeah, isn't that the third quarter of 23 to see that
Yeah.
decline? Yeah. So the first 6 months of the year, I think it's expected to stay where they are.
So
basically, but in the third and fourth quarter, potential decline.
yeah. So I think that to answer your question as best I can, I don't think that people want to buy right now if they can hold off. I think a lot of people have the understanding that it's going to get better. This isn't 08. We just alluded to banks are flush with deposits. People are flush with cash. That was not the case in 08. Dodd-Frank worked. There's good mortgages on the books right now.
I would also add to that we find that most of our clients have more equity today than they did in 08 and 09 as well,
Yep.
which makes a huge difference in their behavior and what they do.
Absolutely. So it gives them a little bit more flexibility to be patient. With that, I put up my opinion on here is if rates go in the high 4s and low 5s, that's kind of the sweet spot, coupled with the fact that, I would like to see prices drop, especially up here 10 to 15%. They've been up 40%, give or take, in our market over the last 2 years. So 10 to 20% is just a natural progression and gets us back to a better place. And I think that will provide a more robust purchase environment.
You must not have your house on the market.
No, and I think that's what we're seeing is people are very, very reluctant to sell because I don't know the exact number, but like 70% of all, 65% of all mortgages are under 4%. Wow.
Yeah, I was reading an article in the Wall Street Journal this morning, actually, that in 20 and 21, when the refinance boom happened, I think there was something like 19 million people could benefit from a refinance. That number today is 133,000.
Wow, geez.
Wow.
So that refinance, you know, in part of what we do is all but gone. So yeah, just interesting data.
Yeah. So I don't know if that answers your question directly, but there is light on the horizon. It's just going to take a little time. And you know, if I were looking to sell my house, I sure wouldn't with a rate, you know, in the low threes. I don't know if the low threes are going to come back anytime soon, if ever. We got really spoiled that way.
It was almost artificial.
Yeah.
I've never seen, first home I bought was in '07 and I was at 6.5%,
Yeah.
and that was a great rate back then. So I feel like what we just witnessed over the past couple of years is just artificial
Yes.
to some extent. I think 5.4 would be great.
Yeah.
And if we transition into that 4.5, I could see kind of the frenzy we just came through happening again. You know, because buyers will be wanting to lock in at that. Sellers will be thinking, okay, what's our home worth now?
Right.
All rates are low. So I feel like that 5.4 is really a sweet spot if we get there.
Yeah, I agree.
Yeah.
I think it's somewhat ambitious to think that at some point in 23 it'll be at 5.4%. We'll see. I'm with you. I would love to see that, but time will tell. The other obstacle to the question that you asked is just qualifying. It's a huge challenge right now. And if you want to go back a couple slides, we'll look at just some quick data here. That's perfect. Payment amounts, minimum, you know, principal and interest payments have increased exponentially since just the beginning of the year. If you take just a principal and interest payment on a $480,000 loan at 3%, that's what we could do in January. Principal and interest payments a little over $2,000. Today at 480 at 7%, it's a little over $3,000. So you go up, same house, potentially more down payment because values have increased over the last, year and a half, and gas, groceries, cost of living is up. So it's just, I had a slide that I was going to put in here, but I think there's just in the last 8 months, 24 million households have been excluded for qualifying for a $400,000 mortgage that qualified in January. So it's real, and it's certainly a challenge. I think we're denying more loans right now than we can almost get out. So we're still fielding the calls, and the expectations are that, I can qualify for that. And we go through the numbers, and then you can start to see the wheels turn, and people going, there's no way I can afford that. I said, I know. You could, when you walked into my office a year ago, you could qualify for it, but that's gone, unfortunately.
Yeah, when you put it on paper at the 3.11, it's 2565, and then that same loan today is $4,000. That's $1,500 in cash outlay a month. Well, wages aren't going up that quickly, so, and that can clearly illustrate the impact of purchasing power on just that shift in interest rates of 400 basis points in 7 months.
Well, and property taxes after the selling frenzy.
Yeah.
Property taxes are a moving target right now too.
Yeah. Yeah.
Trying to factor that in to a payment that's going to be already high.
Yeah, it's very difficult. That kind of answered what you were after there.
Very much.
Okay. What else do you guys have? Really, my goal is to talk with you, not at you. I don't want to read through these. There's great information in here, but I want to know what you guys are seeing. And I guess my question back to you guys is we don't get to see cash buyers. Is that still very prevalent in our market? Are those the people that are still buying up here? I mean, we're still a destination. We're going to stay that way. But I would like to know from you guys, are you still seeing a high influx of cash buyers coming into our market?
I would say the cash buyers are lessening. I'm down in Lake County, but we didn't see as many cash buyers down there to begin with. But they're definitely getting smaller and smaller. So you're seeing more people that are trying to finance. And if they're able to finance, they're kind of that cream of the crop buyers because they're able to afford those interest rate hikes.
Gotcha.
I'll speak specifically, it's more of a commercial listing, but on that listing coming live 3 weeks ago, I think we've had 4 inquiries about owner financing on that.
Oh, interesting.
So on the commercial side, that's become a pretty common part of the discussion.
Yeah, I imagine. Interesting.
Yeah.
Okay. We could probably jump forward a few more slides here.
And don't want to skip by assumption, or rather buydowns. Rate buydowns, that's something that I think all of us are really interested in.
We'll hit on that hard here. This shows that rates are at their highest point in 22 years.
Yeah.
So, you know, that's for most home buyers, they've never seen rates this high. And, you know, going back to and talking with people that bought homes in the 80s, you want to say that rates were 14 to 18%. That's true, but housing prices were not even close to where they're at today, and that matters. It comes down to debt to income, right? And basically, it's never been as tight as it is right now for qualifying and getting people, you know, pre-qualified to be able to purchase. That's a pretty polarizing graph, I think.
The spike in January, that was before the feds, I believe, announced that they were going up. It was in anticipation of that. Is there any foreseeable forecasting where that's going to be taken into account for with the next jumps, that they're not going to necessarily go up with the mortgage interest rates?
Good question. My take on that is it's pretty well documented what the Fed's going to be doing over the course of the next 4 to 5 months. And what we have to do is follow essentially the 10-year treasury yield. And that doesn't 100% correlate with mortgage rates, but it's a great indicator on where the economy's headed. We're heading slowly towards a recession, there's no doubt. So I anticipate that the 10-year treasury is going to keep increasing and mortgage rates are going to keep increasing. And until economic data shows that inflation's cooled and doesn't, looks like, we've passed and we're on the other side of this, I don't think rates will come down until then. I don't know specifically how rates are going to be impacted over the next 2 months. I think if I did share an opinion, and that's what it is, I don't have a crystal ball on this, but I would anticipate seeing rates closer to 8% in late December into January and February. And Jill, I don't know what you think on that, but
I would agree with that. I think they're going to keep moving up here until the inflation is somewhat under control. And then, as Sean said, we're flirting with a recession. Some people would say we're already kind of with toes in. But I think they'll keep going up for the next few months at least.
so that presents challenges with locking in right now on our end. If we were to lock something in, say at 7% today and we close in 60 days and rates are 8% and we have to sell that loan, that means we're essentially losing money on that.
Yeah.
So that's just another side of the coin that we have to deal with. And with rates increasing as much as they did, it presented a real challenge, especially when they started to skyrocket starting in March and through August and September. That was tricky to navigate.
Yeah, I got a few more gray hairs, I think. Yeah, in all seriousness, loans that were locked in February that closed in late April or even early May, I have to manage the way when we sell and I see the fees loss or gain, and we had a couple loans that were in excess of $15,000 to $20,000 loss because that moved up so fast. Now, granted, we can absorb that, but it was a challenge. I mean, that graph to me tells a perfect story right there. What happened in those early months of this year. So.
And I'll just touch on this quickly. This isn't your world, and you probably don't care too much on it, but it's important because it impacts everything that we're talking about right now. Mortgage-backed securities and investors right now do not want to purchase loans. And they don't want to purchase loans in mass because their whole business model is built on those mortgage-backed securities and loans being bundled, and they want to service those for a long period of time. Anything that's being sold right now, the notion is within 2 to 3 years, all those loans are going to get paid off. So what that is, it's a huge constraint for us as far as finding outlets for loans. And you know, we have to be smart with what we're going to be putting on our books and using our deposit income base to lend out for loans and keeping loans on our books right now too. But that's presented a huge challenge. We're getting limited government pricing. VA, FHA, they don't want to service these loans long term right now because they know they're going to get paid off. They're going to take huge losses. So just something that I want to point out, that it's happening, it's relevant, and it's making options for loans tricky. You guys have any questions on any of the general outlook or rates, or we're headed anything else?
I've heard that when rates go up, home prices go down. Do you see that at all happening?
I think they're correlated. So in order, that was the whole goal with when the Fed's increasing rates here. They're trying to drive prices down. They were out of control. 40%, 50% increase, you know, over 2 years is not sustainable. And so you're seeing the Fed purposely increasing rates, and that just has a direct correlation in home prices dropping, because if you're at 7%, there's no one that's going to pay, you know, an inflated amount of what a home's worth. So they're starting to come back down. And one of the slides that I have in here, I'll show that Kalispell is one of the 20 places in the nation that's had, you know, home prices decline more than 5%. And I think that's, sure. I think that's important to see. We're starting to see that already. So a lot of destinations on there, a lot of places in the western United States. You know, we're down almost 7%. I think that's lagging. That is, you know, we're now 2 months past that, or at least a month past that. I would say that's probably creeping closer to 10. And so, I mean, that they did a study over 400 markets in the United States, and for us to be, you know, in the top 10 is, I think that speaks volumes.
And they're all markets where it appreciated off the charts, right?
Right.
Yeah.
So the correction had to happen.
Yeah. Anything else you want to add to that, Jill?
No, not really. Sean showed me this graph, and I was taken aback by Kalispell up there high. The bank operates in some of those markets too, Glacier Bank or Colorado, or that's somewhat in our footprint. So we're watching that closely.
Perfect. All right, we can go back to kind of where we were.
Start into this.
Yeah, I think so. So generally speaking, and this is kind of why I mentioned it, but it's been a pain point with figuring out when to lock rates right now. I'm not a gambler, so I would tell all my clients that, you know, if you can lock in at 7 right now, I highly suggest that. No one knows where rates are going for sure. Odds are they're not going down, and if they do, it's not going to be very much, and it'll be short-lived. So generally speaking, a lender can lock in and secure a rate and honor a rate for 60 days. And then after that, generally speaking, you'll start to, you have probably 30 days after that for an extension, and that's a cost to the borrower if we go by that. Average closing times, and Jill, correct me here if I'm wrong, but I think we're tracking still anywhere between 30 and call it low 40s for government loans if we need more time on VA stuff, but between 30 and probably 42 days, generally speaking. You can click next slide.
Are there any parameters for refinancing?
More
So
specifically,
if you lock in at 7% this month, is there a time frame for when that loan could be refinanced if rates go down in 23?
if you sell it, there's generally an early payoff penalty within 6 months, but that's more in the gray area of where we live. You can't really stop someone from refinancing. So generally speaking, no, there's not any parameters on that.
Yeah, I maybe if you're looking to do cash out, there's some seasoning requirements there. I believe that's 6 months from the date you buy. You have to have ownership in that to take cash out, but a rate term refi to get just a better rate. There's no seasoning on that. Yeah.
Good question. So we can get in now to cost of points, buy downs, 2-1 buy down versus your sellers dropping their home prices 10,000, 30,000. I guess the simplest way to explain this, and I don't necessarily believe in buying points down. I think the average life of a loan in the US is a little over 6 years. So in order for buy downs, just traditional points buy downs to make sense, you have to stay in that house, generally speaking, 5 to 6 years for it to start to recoup that buy down. And especially in today's environment, odds are you're going to be refinancing prior to 5 or 6 years. I have put in here that, in this example, $480,000 loan at 7%, your P&I payment's a little over $3,100. Generally speaking, if you were to buy a point, it's 1% of your loan amount, so $4,800, and 6.625 usually gets you about a quarter of a point. And the difference in monthly payment, about $120. So to recoup your $4,800, if you were, the buyer's paying that down, it's going to take you a little over 3 years to see that realized. Now, if it's in the form of a seller credit, if your seller wants to give that, sure, I think that makes it worthwhile, and it certainly sweetens a deal for a buyer. And $120 is $120. But I think there are other things in this market that we can start to utilize that maybe make more sense and is a win-win for both buyers and sellers. And we'll get into that 2-1 buy down here in a second, but just generally speaking, I'm not a huge fan of buying points down because right now in the market, due to some of the things the constraints that I talked about, that 480, we're probably charging 1% origination just to get to 7%. So that's already $4,800. Plus closing costs, just generally speaking, on a $480,000 loan, all in, you're probably at $8,500, somewhere in there if you have 1% origination. So when you start to add up all those fees, is it worth it? That's something that you have to think about and pencil out. And if you have questions on any of that, call us. We can whip through scenarios like this in 10 to 15 minutes and provide you with that information, or come to open houses, sit down with your sellers, calculate this out to see if it's worth it. But that's my 2 cents on this. Jill, do you have any thoughts on that?
No, it's very much the same. I think we do see people who wanted to buy their rates down 2-3 points because their intention is to stay there, and they see a rate that looks much more attractive than a 1% fee. We have to be really careful of that on our side too, because after 2008, the ability to repay rules came into effect after the financial crisis, and were limited as to how many points and fees can be paid. It has to do with par pricing and things like that. So we have seen people buy down 2% because in their circumstance it makes sense. But I think the key there is to sit down and actually do the math and do a recoup calculation and base that decision whether they're going to buy down or not on their financial goals and what their plans are. Obviously things change, but there are limitations too as to how many fees borrowers can pay.
So one of the other dynamics we're seeing in our marketplace is, you know, instead of the old days when a price drop was maybe $2,000 to $5,000 just so that your listing would get some attention, we're talking tens of $20,000 of $50,000 price drops as everybody's bouncing around in this market trying to find the sweet spot.
Yeah.
So the notion of giving someone a credit of $20,000 really isn't off the table for a seller that's serious about selling. And we're still in an environment where we have price homes that sold within 6 months that are still at a high enough level that the appraisals can still come in.
Yeah.
If we keep declining, then the appraisals become a problem.
Yeah.
Yes.
But we're in a really interesting spot right now where I think that sellers may be open to this and really making a home more affordable for the buyer, which is kind of bottom line.
Yeah, I think we'll get into that a little bit more, Jeff. I think that those large, your 20,000, so there's two prongs to that. There's the limitation of how much a seller can contribute and where it can actually go. So if you write it up, 20,000 to closing costs and prepaids, we might not have $20,000 in closing costs and prepaids. So you're effectively leaving potentially thousands of dollars on the table. So then that buy down piece will become even more important because if you write it up to a buy down and closing costs and prepaids, then we can utilize more of that credit. That's a really great point where some people are willing to do larger credits to move. So we want to make sure we can use them all when we get to the closing table.
Yeah, and I think you'll find that we're going to have the lender much more involved in the negotiation
Yeah.
at the onset of these deals before we even get them completed and signed.
It really, yeah.
A great call.
Yeah.
Yeah. I think we can probably head to the next slide.
Okay.
Okay, so 2-1 buy down, just generally speaking, lowers the interest rate for a buyer over the course of the first 2 years of the loan. So in the first year, the interest rate's 2% lower than their note rate that's going to be for the life of the loan, and then in the second year it's 1% lower. So really, everything that we described, this is almost tailor-made to what we're seeing right now. The whole goal for this would be, years 3 to 5, you'd refinance, or sooner if rates dictate that, or warrant that. But it really provides, as you'll see on the next few slides, go ahead, Jeff, a huge savings to buyers and really a pretty cost-effective way for sellers to get creative and work with a buyer here. It's a really good option. Maybe click a few more. I don't know how many. One back, one forward. So again, if we're going to take just an example of a $480,000 loan, and the current market rate's 7.25%, your principal and interest is $32.75 a month, or really the total payment for that year is $39,300. So what the 2-1 buy down does is we still have to qualify the buyer at 7.25%. We need to ensure that they show the ability to repay at 7.25%, because ultimately that's what they're going to be paying for most of the loan if they stay in it. But what this does, the first year, the rate will go, and when you make your first payment, it's 5.25%. So for the first 12 months, your payment is $2,650. So in year 1, you're saving $7,500. And in year 2 at 6.25%, you're saving $4,000. So over that 2-year period, you're saving $11,500. That's big. And so for a seller, how this works is a seller can contribute, a real estate agent can contribute, builder, employer, parent, friend. There's a lot of different ways that this can be contributed. So that $11,500 difference is collected at the time of closing, is listed on a closing disclosure, and it's held in an escrow account at the title company or the servicer of that loan, just like taxes, property taxes, and homeowners insurance. And each month thereafter, it's used just like an escrow account. Let's say that the borrower decides in a year and a half rates dip to that 5% zone, and he wants to refinance, he or she wants to refinance. Anything that's left over in that escrow account bucket of that $11,500 goes into that buyer, stays with them, just like taxes and insurance would. So it's a huge benefit. And instead of dropping, your house price $30,000, maybe this is kind of a concession that works for both sides. It saves, the buyer tremendous money, and instead of contributing $20,000, $30,000 towards closing costs, which Jill alluded to, we really can't. There's not enough money there to do that. You can do a buy down, and then you can contribute, another $10,000 towards closing costs and prepaid. So you can do both. Jill, jump in anytime here to expand on any of those things, but it's a really great option for this time in our market.
Yeah, when we get these buy downs, we'll go in and do the math, just much like Sean did. We'll just plug it into our system and it spits it out. Here's the cost, and then we itemize that on our disclosures we have to do, and it shows up on all the closing disclosures. That if there's more money, we can get a little even more creative. We could potentially buy down the rate as well. So the previous two slides, if there's extra money, if the credit is large enough, we can actually then go use to buy it down to a certain extent. So then you're really getting your borrowers, or our borrowers or buyers are really getting a great deal. So there's a lot of ways you can play with that math. I think the biggest thing, and Jeff, you hit on it, is I think you have one. Give Sean a call or give myself a call, and we'll say, here's kind of what the math looks like. So we don't want to be leaving money on the table, or you just have to make sure we're doing the math part of that correctly. But it's a huge savings, and when you put it on again, illustrates how much it can save from the buyer's perspective.
And buyers can still elect to do bi-weekly payments too?
We don't see that too often. That'd probably be an investor specific requirement. I would say that they probably could. We would just need to flesh that out if that was a question. Okay. Yeah.
And these are popping up now. So we've never really dealt with this. There wasn't a market that, really had the demand for it. And so we're learning on this as well. We're brushing off old documents and notes and trying to figure it out. And, really, I think these are really going to become much more prevalent. The one caveat that we haven't nailed down, and I don't think we have a jumbo investor for, but this is good up to the conforming loan limit.
Which is to go to 715, I believe, at the start of the year. It's 647,200 right now. And the rumor on the street, or the grumblings we've heard, is conforming will go to 715,000.
Something to keep in mind there.
The other thing, the only other comment I would have, Sean's right, we put this on the shelf back in 9, 10, 11, and we're dusting it off. One of the comments, one of our lenders who was here back then said, well, the seller would say, I'm going to sell for 500,000. Well, I'll increase my price to 515 and then offer a $15,000 credit. Math works out, but then they weren't appraising it. Mm-hmm. So that is a risk. That was something that we saw historically, but something to think about. What other questions?
Maybe jump to it if there's anything else there. Take a look at it. Yeah, just kind of what we hit on that. I think that's a huge benefit, that the buyer gets to keep whatever is in that escrow account, because it's going to cost to do a refinance in 3, 4, 5 years. It is. We're gonna have to get it reappraised and new title, etc. So for me, I'm hammering home at the time of this closing is remember the cost that you're saving when you go to refinance. And if there's anything left over, use that towards that refinance. It's a really smart way to use that.
Let me back you up on this, and you probably need an eraser board to illustrate this. But, okay, now we're in the seat of an agent representing our seller. Buyer comes with an offer. There's a $30,000 delta between what they say their loan can get them and what they can pay, and what the seller's willing to reduce to. What's the math on this? If we explain to our seller, okay, if you'll reduce your price or give a credit of $10,000 or 11 and change, does that make the home affordable for that borrower versus a $30,000 drop? Where's that math
Yeah,
to explain it to a seller?
I'll take a stab at this.
Okay.
Make sure I understand. Maybe I'm going to blow this up, I don't know. But it doesn't change what a borrower can qualify for. So if my loan amount, the max loan amount that Jill can qualify is $480, and I can't get there at your seller's price, because all that number is static. I'm qualifying at 7.25 at $480,000, and I only have X amount down. Those numbers don't change. So if your seller can't reduce the price enough to where I have enough down and I qualify for this loan, so those are just static numbers. They are what they are. I can only qualify for so much. So in that instance, and I think I got this.
You're on a roll.
But, okay. In that instance, that price reduction would have to come into play. Agree or no?
Agree. And I guess I'll just expand on that a little bit, that for every $1,000 that you increase or decrease your purchase price or loan amount, your payment changes by about $5 on a 30-year term. The term it's just so extended that $1,000 of a drop in loan amount doesn't really do much to your payment. It helps with down payment. You know, if there's someone that's what you should talk to your sellers about, and in conjunction with the loan officer. If you have people that are close to, being able to put 20% down and avoid PMI, a price drop might warrant that. Mm-hmm. And that's a great way to help a borrower qualify. You take less of their money for down payment, and you reduce or do away with completely mortgage insurance. So I think that's more of a qualifying piece than the 2-1 buy down, because the 2-1 buy down, in the spirit of what that program is for, is huge savings in the first 2 years of the loan to help that person get by when rates are really high, knowing that hopefully in 2 years rates come down and they can refinance into a more manageable payment. But on our end, like Jill said, we still have to do our due diligence, because what if rates don't come down? We don't know. We need to ensure that person is comfortable. That's number one thing for me. I look across to all my clients. There's two things that are important. I can tell them, one, this is what you qualify on paper. This is what the numbers tell me. But I look at them and I say, what are you comfortable paying? I'm not making your payment. I don't know. That's what I want to hear from them. It's very important, because those are two different things.
Yeah. Mm-hmm.
And there's stuff that we don't account for. We get to use gross income to qualify. They're not realizing that income. We don't have to account for cell phones, regular insurance, stuff like that. So it's really, from our seats right now, it's a huge educational piece that we have to work with, and there's so many different prongs to that. The qualifying piece that hopefully I'm starting to get off on a tangent here, but hopefully that answers a little bit of your question.
Yeah, I think it's a matter of what someone can qualify for, what that purchase price is, and the down payment comes into play, and how do you make all of those pieces work? Because we can't increase what they qualify for, that number doesn't change.
Okay.
Yeah.
Thank you.
Yeah.
Anything else as it pertains to the 2-1 buy down? No. Okay. Do you guys know about that before? Is something that you had been somewhat familiar with?
I've heard about it, but I forgot about it.
Yeah.
Yeah.
Never been involved in one.
Yeah.
So this, I think, touches on your point that you were just trying to make a little bit here by dropping sales price from 600,000 to 575, assuming 20% down. The monthly payment changes by about 133 bucks, $15.96 annually. Whereas the 2-1, we just illustrated that in the first year, potentially on a loan of this size, it's about $700 or $7,000 in savings. So for qualifying, no, we're not really. It's not really something that is involved here, but from actual realized savings from a buyer's perspective, the difference is huge and significant with the 2-1 as opposed to dropping $25,000 on a sales price.
So if your buyer could qualify at a 600 purchase price, but your seller didn't want to drop, they could give that $25,000 credit if your borrower qualified for both of those loans, if that makes sense. And then you could do that 2-1, and it's a savings to them.
A much higher savings.
Yeah. Rather than drop.
Good. Okay,
Okay.
we talked about that.
I put this on here. I follow a lot of mortgage things on Twitter, and I just found it fascinating that everything in our industry is cyclical. And this was from a mortgage company back in 1986, 87. So this is more to say, and maybe to tell myself that we've been here before. We'll get through it. And 3.5 points on there, I'm going, oh my God, that's crazy for almost 9%. So I just got a kick out of it. It's something that it is what it is, and hopefully we don't see 8.5%, 9% rates, but if we do, we'll get through it together. We'll leave this up here for a little bit. I know there was other subjects that you guys wanted to get into, and that was, one of them was assumable loans. And Jill cut me off for jumping in at any time here, but assumable loans are FHA, VA loans, and becoming more prevalent, obviously, in our market. But as a bank, when we originate those loans, we do not service government loans. We sell those to specific places that do service government loans or to the government. And when you have a transaction that you're working on where the seller has a VA loan and it's with, we'll just say PennyMac, and they're servicing it, that buyer and seller have to work together with that servicer, PennyMac, on an assumption. And so what we can do to help is be a resource. We can, on clients' behalf, call PennyMac, whether they talk to us or not, since we're not involved in the transaction, they probably won't, if I'm being honest. It does take a lot of time. PennyMac will do their due diligence to ensure that the buyer qualifies to assume the takeover of that loan. They don't want that buyer to default on the loan that they have on their books. And I think that process is pretty arduous and timely. And I've heard from recent title companies, and that might be a better outlet for you guys to talk to, is the title companies, because they are almost brokering these and working in between to figure out all the numbers. And I've heard that it's taking anywhere from 6 to 8 weeks. That's just what I've heard. I have no idea about this, but really from our perspective, we can't lend ourselves to help very much in assumptions. And we don't know a ton about them, to be real candid. And Jill, do you have anything to add to that?
No, we've done several on the commercial side years ago and worked through an attorney to draft the assumption agreement. I would imagine a VA or an FHA loan has a more streamlined process, but our hands are tied as to how far we can take it because we don't service it. So really and truly, if I'm trying to assume Jeff's loan, I have to credit qualify by myself or however I apply, and then it has to go through that servicer's credit qualification. Those servicers are huge, and so do you get lost in the shuffle? I would imagine so. I would think that the process will take a bit of time. So, but if anybody has any questions on how that works, we can certainly provide some insight from the bank's perspective.
Can you do it on any government-backed loans, like RD as well?
I was gonna say, I think RD, I'm trying to think of I think you might be able to. I can double check on that. I know that, RD, has its own set of restrictions, but with income restrictions.
Correct.
So I think you can.
Yeah.
We just don't see them a lot.
Yeah, well, I see a lot more RD loans down in Lake County.
I would imagine, yep,
Most of our loans are RD,
Gotcha.
so.
yeah.
So it makes sense to be sure our buyer is working on a regular loan in conjunction and in
Correct.
parallel.
Probably a really smart idea. Yeah.
I would see the benefit of an assumption, especially if that rate was really low. That's kind of attractive if you're assuming a 4% loan. But there's pros and cons to both sides of that.
I know another subject you wanted to just briefly touch on. Jill and I were trying to put our heads together to provide a good answer on this, but it is a tricky question, and that is, when does rent become better, more feasible option than purchasing in a high interest rate market? Tough question. It's very case by case. It's so case by case, and I guess what I would say on that is, if you have clients that are on the fence about that and don't know, have them call us, have them come in. You guys are welcome to join that conversation, but it's so individualized and tailored to that individual on, does it make sense for them? And what we'll do, I never like to make assumptions or decisions for any of my clients. I like to present options. Options are good, and like I said before, I'm not making their payment, they are. They know what's comfortable, I don't. And so to give them that information and let them make decisions, because I don't have a crystal ball either. In 2 years, rates might still be high, and maybe renting was the right thing, because we are starting to see rents come down. How much in our market with inventory issues, that's a challenge. I don't think that they're going to drop as much as they are nationally, that's for sure. But my answer to that is, it's so individualized that get them in to see us, and we can give them information to try to make the best decision possible.
Yeah, I agree.
Okay. What else?
Are you seeing a lot of construction loans?
We're very lucky that we are in that line of lending business. So yes, we are seeing that. Challenges that we're facing in that arena right now are the cost nationally for lumber, supplies, the supply chain's coming back. They're all decreasing from their peaks from 20 and 21. So we're starting to see that. And we're running into issues with appraisals, appraised value matching up with, or being in line with what a builder thinks cost to build is. And I'm not a builder, so I'll be careful in saying all of this because I'm not in that arena. But for the last couple of years, with where rates were, with where supply chain issues were, and the difficulties obtaining subs, and what you have to pay those subs, builders could put almost whatever they wanted on paper, and people were willing to pay it if they could afford it and qualify for it. And that's still happening because there still is such a demand to build, and you still have to pay subs crazy amounts of money to get them to show up to the job. But dollar for dollar is not matching up with value right now, and so that's really a challenge that we're seeing right now, especially on high-end homes. And out of my pipeline right now, maybe 50% is construction loans. So we are seeing that simply because we don't have any refinances, and the purchase market is such a stalemate right now that construction is a great outlet for us right now. And we get to set and maintain what our interest rates are on those products. So we have a little bit more control and flexibility.
Our average size construction loan last year was 714,000. Year to date this year, it's 814,000. Yeah, so large
Wow.
projects.
Okay.
With an equity position at about, on average is 35. So our average loan to value is 65. So there's a lot of cash coming into these builds, high-end builds. Yeah.
So it's a 1.2 to 1.4 price range, 1.2 to
Yes,
1.4 million.
correct. Yeah, exactly.
Gotcha.
Are you saying appraisals being waived?
Property inspection waivers on,
I've had
Like that.
2 appraisals on properties. Conventional buyers 20% down, and the appraisals were waived.
Oh, yeah.
So are you working with like going off the CMA or what's?
What I think's happening there is Fannie Mae or Freddie Mac, the agencies that we sell to,
Okay.
they have a database that they've built up over time, and it has just we have to turn in, if you will, our appraisers. We have to run it through their database if we're selling out to secondary. So they collect all that data and they put it into this big thing. And if the property, let's say I'm in downtown Kalispell, and their data says that the purchase price seems fair and accurate, they'll oftentimes issue, when we put it through their system, a PIW or a property inspection waiver, and that means we don't have to get an appraisal. Yeah.
so it's not the lender saying there's no need for
It's
an
not the
appraisal,
lender.
it's the agency, Fannie and Freddie, that they're selling a loan to, saying that we
Yeah, we think your data's good. We
Yeah,
think
the-
that price is right. Yeah.
we agree with the value and we're in line with it. And you know, if you want a snapshot into the future, that's where appraisals are going. There's enough data out there that whole industry is going to be automated. I don't know when, but that's just where everything's headed. So
I just thought that was really interesting coming,
Yeah.
from an inflated market.
Yeah,
to see
yeah.
that.
We've received PIWs where we wouldn't think we would,
Mhm.
and conversely, we've seen PIWs, or we don't get them when we think we will. It's just, it's not a fine science, but it's getting more. We haven't seen it in a while.
a few here and there, but yeah, not for a bit. But I think to Jeff's point, he was illustrating is we're in that sweet spot right now that you can still find a comp from within the last 6 months to support
Yeah.
that data. And the further we go down this, price reduction market, the less PIWs are going to be prevalent. So, good question. It's just something that
So the buyer still has they can still elect to go
Yes.
through that process. They
Yeah.
say it as like a green light. And I'm like, I don't know, we should maybe.
Yeah,
yeah. So when we see that, we let them know and give them the option that it's up to you. You don't have to get one, but talk to your agent, see if they recommend that you get one. We just got to give them heads up early on in the process that you don't have to have one. It's not required.
When you see owner carry, do you have an idea of what kind of rates are being applied there?
I can't speak to that specifically, but generally speaking, I would imagine that it's kind of whatever it takes to get the deal done. So if rates are at 7% today, maybe that owner would love to get paid 6%, over the course of 2 years with a balloon after 2 years, and that person needs to go obtain financing from a local lending institution. That's kind of how it works, generally speaking. It's usually below what the current market value is, otherwise you wouldn't do it. Unless there are caveats to everything. And I'll just generally speak to this, but if you have someone that has a 600 credit score, doesn't qualify for financing, or the financing that he does qualify for, the rate's at 9% because of the risk assessment. But let's just say for whatever reason they've sold another house and they're flush with cash, they want to buy this house, but they can't either obtain financing or their rate is 10%. It's crazy. That's a perfect scenario where you could use 7% or 6% of owner financing and get a deal done. So I put this last slide on here of, obviously we're all here for a reason. I would say that most of us love what we do. There's no doubt that the market right now is presenting challenges that we've never seen, or most of us haven't ever seen. And you know, what I'm working on right now is it's an opportunity to improve on my messaging, efficiencies, marketing, relationships, right? We haven't got to do that over the last 2-3 years. It's just been, you know, go, 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 can't catch your breath. And so this is refreshing to come in here, speak with you guys, hear what you're seeing, impart some of what we're seeing on a daily basis, and, you know, more or less connect with you guys to say that we're all in this together. We're all seeing the same thing. And I think it's, you know, with every challenge presents an opportunity, as we were talking about. And, you know, what a great opportunity to get in a room with you guys, not have masks on, be able to, to talk and, you know, more or less work together on this. So what I would say to you guys is the only message right now is to stay positive and to be there for your clients, because it's difficult. Difficult decisions to make to sell a house when you're going from a rate of 3% to 7%, or, you know, when life is so expensive right now and so uncertain. We live this, so we have a kind of a pulse on where we're at. But if you grab someone on the street and said, you know, rates are at 7%, most of them, they wouldn't know. And most of them wouldn't know what that does to a payment if they're trying to qualify. And so buying a home, I don't tell you guys, is very personal, biggest purchase that you'll ever make in your entire life. And so when they come and see us and get discouraged, we've got to work together to put a plan in place for them to say that this isn't forever, but this is what you need to work towards. And so if you guys don't have any other questions, we just really appreciate the opportunity to be here and have this discussion with you guys. And Jill, I'll give you the last word if you have anything.
No, thanks. Yeah, thanks so much for letting us in your office this morning. Jeff, can you flip one more slide for me? This is for fun. We'll end on a positive. We track our out-of-state borrowers. This is just Glacier's data. There's nothing confidential in here. So we track by where they're coming from and by loan purpose. So you can see purchase is the majority, but our friends on the West Coast there in California continue to be the highest. Washington, Texas. New this year in 22 is the Midwest. We haven't had there's only onesie twosies over there, but we're seeing a lot from the Midwest. And then by occupancy, which is, I put this in here just to see how many of these people are actually moving here permanently. So it's a third. That investment property piece is all noise, because this includes all land purchases. In our operating system, we code them as investment. So that's really just land purchase there.
Okay.
So just a third across the board. Primary, second home, and then land purchases. And then the next one, if you would, Jeff, just what counties. This is, again, just Glacier's data. You can imagine all the other lenders that are in the Flathead Valley that have the same thing. So it's still significant. Yeah, and where they're going. But that's just for fun. And we're here to help answer any questions, and as Sean said, just work together to, when you get something or need anything from us, just give us a shout. Yeah.
Thank you.
Thank you guys.
Yes, thank you so much.
I want to close with one last statement. And Sean, you mentioned to refer them to a local lender. And boy, we couldn't agree more. We're all very accustomed to and have worked with Glacier Bank a lot. You're one of our favorite local lenders. You take good care of our clients for us. And we appreciate you taking the time to do this.
Absolutely.
And I think all this information is going to be really helpful to us. So
Awesome.
Thank you.
Yeah,
Thank you guys.
Okay.
all right. Thank you.
All right.
Thank you.
All right. And if you guys have other questions, seriously, shoot us emails. We don't have the answers to everything, but we can sure look them up, figure it out for you.